we are at the beginning of what could be another round of stimulus here in the United States. So to talk about this and where we're headed, we want to invite into the program Michael Kushma. He's Morgan Stanley Investment Management CIO of Global Fixed Income. Thank you for joining us.
Thank you. Thank you for having me.
So I want to start with the EU plan and what you make of it, and then what it signals we might need to still do in the United States.
A good question. The EU plan has been been discussed in the public for a while now. Originally, the President of France and the Chancellor of Germany got together and announced they were supporting a 500 billion euro grant. In other words, grants to member states who needed help fighting the COVID pandemic. And that sort of opened the door to European federalism, which would be the first crack in this idea of sharing fiscal resources across countries. In other words, Germans might be taxed to send money to Italy, call it the Hamiltonian moment, simply because it's like the United States, where you have transfers from one state to another effected through a nationwide or federal system of taxation and revenue sharing along the way, essentially. So this is a momentous moment for Europe if it happens. But again, as just previously discussed, it needs to be supported by all EU states in order to get this done. But I think that the need for it is quite paramount. The question is how much horse trading will go along and what will the size of it be in the end. Grants are better than loans for sure, because some of the countries in most need of the funds, the Southern European countries, are most indebted and have the least capabilities of paying that money back.
Well, Michael, it's Julie here. Thanks for joining us. So it's interesting to see that there. I mean, we know that there tends to be those kinds of schisms in the EU, but we're also, of course, seeing it here in the United States. Mitch McConnell has talked about the need for more stimulus. There seems to be that general acknowledgement. The question is, what kind of horse trading will be necessary here in the U.S.? What kind of stimulus do you expect is still yet to come here, and what effect? How much is it going to help?
It's a good question. I think that's what we need down the road. So far, I wouldn't characterize what we've done in the U.S. so much as stimulus as income support, whether it's the Fed providing support to financial markets, in the treasury market, corporate bond market, the asset-backed, mortgage asset-backed securities market. It's support to make sure those markets function properly and money still flows to people who need it. And the federal government has given a lot of unemployment insurance contributions, money to people to support incomes during this high period of unemployment. Going forward, as the economy opens up and lockdowns become less strict, people will want to spend money. Well, you can't spend money unless you have. The next round is truly going to be designed to make sure, on one level, that individuals and corporations spend money as they're capable and allowed to spend money, and they're optimistic about the future. Secondly, I think the second component of it, and this is a more a democratic idea, is support for local and state finances, which have clearly been ravaged by the cost of dealing with this in many states, the healthcare costs as well as the tax costs in terms of lost revenue on income taxes as well as retail sales taxes. So I think that it's a two-pronged attack. One is to better support the public sector of the government entities which are most in the forefront of fighting this pandemic. And secondly, to make sure spending increases. Could be infrastructure spending, could be increased unemployment insurance so it doesn't run out at the end of July. I can make sure that as economies open up, people have money in their pockets that they are comfortable spending. And the national savings rates, which has soared obviously over the last 2 months because you can't spend money, that savings rate comes down, and that will come down if people feel more comfortable about the future. So the next round, I think, is about getting people to spend money. And I view the fact if the individuals don't spend money, the federal government will have to step in and spend money itself on things.
Well, Michael, I'm curious how big this next round of fiscal stimulus needs to be, and who benefits the most. Will it be people who, invest in bonds, whether it's muni bonds, or is it going to be people who invest in perhaps good old-fashioned corporate equities? We've got Governor Cuomo here talking about major infrastructure plans.
It's a good question. I think that the municipal bond market has, like other bond market sectors of the bond market, been disrupted, and because of this, and clearly state and local finances have been extremely disrupted on the back of this pandemic. and that needs to be shored up. So I would expect that the program of the horse trading, which goes on between the Democrats and Republicans, I don't think there's a real budget constraint right now. We're at war against this medical problem, and that we need to spend whatever it takes to accomplish that victory over time. So I think that there's less of this versus that, as opposed to give money to all endeavors that both parties want to see supported going forward. And certainly the municipal bond market should benefit from that as money flows into state and local government coffers to support spending. We don't see teachers being laid off and public health care workers being laid off. We don't want to see that. That's both negative from a public policy point of view, but also from an individual point of view, those individuals not having money to spend and going on unemployment, et cetera, et cetera. And secondly, we want to make sure that spending is done, that there's an opportunity to engage in programs which have been discussed for a long time, national broadband access, all sorts of things. Larry Summers has talked about national infrastructure spending and air traffic control system upgrades, although we need to fly more planes in order to justify spending more money on air traffic control systems. But there's lots of programs, I think, which we can talk about financing, which can be long-term projects. All of 2021 and 22 can be spent on these issues. So I think that there's enough money. The country is wealthy enough to spend money on all worthy things going forward. And yes, we need to spend money probably need to spend money on infrastructure spending, and that will help companies involved in that sector.
Hi, Michael. It's Julia LaRoche. I'm sensing some optimistic undertones from you, and I thought it was interesting in your notes. You were talking about this tug of war between the optimists and the pessimists within the bond markets. I was wondering if you could unpack that further for us, and what do you make of that, and what are some of the implications?
Sure. It's clear that many people, you said ask for people in the maybe 2-2, 3-1, but there'll be differences of opinion about optimism versus pessimism. Do we have this situation licked enough to open the economies up so that we should be positive, that we've seen the worst, we're living through the worst economic conditions, it will get better, and we should be optimistic, meaning think of this as a one-off hit to corporate revenue, to household incomes, then we'll revert back to some normal trajectory. You think about the present discounted value of all that income streams and revenues going forward indefinitely into the future. This is not that big a deal if it's strictly a one-off event and we get back to normal fairly soon. That's over the optimistic scenario. The pessimistic scenario is that we haven't beat this yet. It is a medical emergency. It's not an economic emergency. And we can't talk about economies returning to normal until we solve the healthcare problem. And there's a lot of differences of opinion of what that means. Does it mean we have to have a vaccine? People are not going to be comfortable going out in public and spending money like they did in the past without being 99.9% sure that nothing's going to happen to them? Or is it just about truncating the downside risk of serious illnesses, and mortality rates dropping near to zero, like they have in some other countries? So Singapore, for example, has had a rising infection rate of late. They've locked things down, but they have a very, very low mortality rate. I saw a picture of people getting on the subways in Singapore, everyone wearing a mask, but they're pretty packed and they're pretty comfortable. The healthcare system can deal with whatever emergencies come up on that front. So there's a lot of difference of opinion, I think, of people who are positive that things are going to get better economically and the healthcare situation will not deteriorate to offset that. And pessimists who think that we're likely to have a second wave of infections down the road as we open up. And the United States hasn't proved capable or willing yet to have the necessary medical infrastructure to deal with the second wave, at least on a national basis. Obviously, being here in New York, we've seen some of the worst, if not the worst, situation with regard to the other parts of the country haven't felt the same kind of per capita pandemic impact that we've seen in New York. If it's isolated to New York, I think we can be somewhat more optimistic that things are going to get better. But infection rates are not going down in states in the United States that are opening up faster. It's just that things aren't getting out of control. And that's, again, optimists will think that things could get worse. Even Germany, when they opened up, acknowledged the fact that infection rates are likely to go up. But if you can manage that and mortality rates go nowhere, we can manage that. That's a cost of doing business. But on the other hand, if mortality rates go up as infection rates go up, that presents a more difficult challenge. And that's really the optimists versus the pessimists. And the bond market's reflecting that in terms of we've had a pretty sharp rally in high yield bonds and investment grade spreads have come in quite nicely over the past several 6 to 8 weeks. And that's been based on things getting better in the future if we have a second wave of the pandemic reaction.
And Michael, that's one of the things, you hear at least Andrew Cuomo, the governor here in New York, talk about manageability with the hospital and having the medical situation in place before we open up completely in New York City. Got to let you go at this point, but Michael Kushma, Morgan Stanley Investment Management, CIO of Global Fixed Income, thank you for being here.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.